rising rate environments. But again, they have that negative convexity component because they have embedded options. So it's something else. That's the other one we probably want to get rid of as well. And then I still think I think I think given the fact that trend growth is only about 1.7% to about maybe 2%. If we go below trend growth, it's much more likely that we actually move into a recession. And if we move into a recession, it's going to be very, very hard for bond prices to remain above 2%. It's more likely that we see them go back to where they were in 2013 and not 2013, but 2014 and 2015. Once we go into the recession, like we'll probably see the 10-year yield probably trade closer to 2% or maybe a little bit under 2%. I had initially pegged to start the year at about 2.25% by the fourth quarter. I think we're still headed in that direction. There's a lot of people that will go on TV and they'll talk about bond vigilantes and people that could actually push or require higher rates. That's not really a possibility. Part of that has to do with the fact that there's a shortage of high yield and high quality debt that the U.S. issues to the rest of the world, which typically advanced economies issue to emerging economies, and that's still in play. So it's going to be very hard for people to shift immediately out of U.S. denominated assets. So as long as people continue to, as long as we run a widening trade deficit and the trade deficit gets bigger and bigger, which it will over the course of this year, there's going to be more capital that needs to flow in to finance it. And the financing, like I said, works in a positive direction it's positively correlated to prices in terms of higher prices in bonds and also higher prices in terms of equities up one to it. The other suggestions that I was making is that you could look at bullet corporate bonds, which basically have no embedded options. They typically outperform in a falling rate environment. You could also look at subordinate debt. Subordinated debt typically outperforms, especially if you're going with extending duration, which just means that you're purchasing maybe a 10 or 15-year bond or a 20-year bond. The other ones that significantly outperform because they have a lot of positive convexity, but they don't pay you a coupon would be zero coupon bonds. Zero coupon bonds are pretty amazing, and also not that you could invest in these because they don't have an ETF that has COCOs, but COCOs have a tremendous amount of convexity and significantly outperform when interest rates are falling, and they outperform for pretty much the same reasons that zero coupon bonds outperform. So there's duration and positive convexity that you could add through the fixed income when we sell these and switch those out, that I think would generate higher return and a higher yield than you would get just leaving the money on Schwab's short-term money market, because again, the money market's going to be affected by the Fed cutting rates at some point this year. And like I said, I was in the one camp hike for May or June. I'm now moving and switching that over to I think it's pretty much likely that there's going to be a rate cut at some point this year. And even if they were to hike rates, you would definitely want to be long duration because it immediately puts downward pressure on the long end of the curve, which the Fed has really ultimately no control of. So shorter term rates would be a good investment at that point because you know that they would have to cut rates, and they have about 275 basis points if they were to hike by 25 basis points. But if they don't hike and they cut, they have about 250 basis points of policy easing available over the course of the next couple of years throughout the recession, which is going to be a very short recession. It's going to be a V-shaped recession. Part of that has to do with the fact that the current account is only 2.5% of GDP, which is a very relatively manageable current account deficit, technically speaking. And then the other part of that has to do with the fact that China is willing to make the adjustment to take on a greater share of consumption. So it's kind of a thing where you have to work with the rest of the world. I don't necessarily like I said, I don't think what the administration did in terms of tariffs was the best solution, but it is definitely a viable and good alternative if you're not willing to work with your trading partners. Again, when I say good, I'm saying that relatively speaking, just given the way that the global economy works. They'll obviously come out with a managed trade deal. It's probably going to be heavily tilted toward energy exports and also petroleum products, and then also agriculture. But there are then some service sectors of the economy once China opens up that are going to be extremely valuable to the U.S. So the rebalancing that's going to take place in the global economy is definitely going to be put on U.S. consumers, but the rebalancing to the export sector in the U.S. economy is actually going to be beneficial, and it should limit the amount of time that we're in the recession because the dollar is going to depreciate significantly. But the other issue that we have is the funding of mandatory spending programs going into the election year, because 2020 is actually a significant year for a number of different things. One, the Social Security actually starts to go into deficit. So we've been running about 40. We went from $150 billion of surplus, meaning that the taxes that come in every year, pay as you go, we're actually paying for it. And now, as of 2018, 2018's budget, we were about $44 billion in surplus. So that surplus in 2020, I think, is going to go into maybe $5 billion, and then it goes negative. Once that surplus goes negative, regardless of who's in office, whether it's a Democrat or whether it's a Republican, they're going to have to expand the size of the deficit, and they're going to have to use foreign financing to finance that portion of the mandatory spending, which is going to require more higher debt servicing costs. So interest expense is going to go up as well. And those things are also going to be The interesting thing is that the U.S. is going to have to finance the interest expense with more debt from foreign financing. And then we're running into the issue of what happens now that China's opened its bond market to foreign investors. Because now China's in the position this year that they're going to be running a current account deficit, which is the most terrifying thing ever. And it's not being presented that way, but it actually is a very terrifying thing, because there's a lot of countries that are building surpluses against China, which means that there is a strong possibility that people could start to diversify out of the dollar and into Chinese assets, not because Chinese assets are good or safe or safer than the U.S. assets, or that they're provide a better yield, but they're just doing it to diversify. If you run a current account surplus with a country, you typically want to diversify into their assets, and you want to hold some of their assets because it makes it easier to finance their deficit, so that you can continuously trade with them and actually better your economic position, especially if you're running export-oriented strategies. So that's kind of a bit of a concern that's kind of being glossed over by, I think, mainstream media and also the Trump administration. And I think that's a big issue that has ramifications on our standard of living, not only for baby boomers but also for millennials. That's probably going to be a gigantic issue that should scare a lot of people. But a lot of people, I guess, are just not necessarily looking at that. But your portfolio, seeing as though it's still heavily weighted toward fixed income, you should outperform over the next couple of years, and I